Good day everyone, and welcome back. Trading strategies, while important, really only represent a piece of the trader's arsenal. It would be disingenuous for me not to at least acknowledge this fact, and it would be irresponsible to not at least make my audience aware of this fact. I'm not speaking here on modes of thinking, of proper methods of learning or training. I'm not speaking of what it means to commit to a belief that makes trading any style even possible to begin with. I am simply providing an extensively tested trading setup with consistent logic and consistent performance that has well-defined conditions for when and how it forms. It incorporates old ICT patterns with some sweet new gear and insight. This strategy not only provides consistent setups, but discourages overtrading by clarifying the profile in which it works and forms. It has robust logic that ensures stop-loss placement is always placed in a resilient location. TP is flexible and can be tuned to reflect personal risk tolerances. I call it Anvil. I share it hoping to command in myself a razor-sharp intuition to the enjoyment of my viewers. So let's move on then to why I call it Anvil. Well, first of all, it's a symbolic representation of the visual component of the strategy. The motion of the hammer's blow against an anvil signifies the delivery of price at extreme points above and below the market. Secondly, it's a metaphor for how I believe market makers employ price as a tool, and in its designation as a tool, it should leave behind evidence of its use, just as a hammer strike might leave residue behind. Also, I find it useful to contrast the power-shaping forces of the hammer strike to the intervention by algorithms. Employed as a tool, price is moved to where it benefits the liquidity provider. This movement, delivered algorithmically, represents a price engine model that simultaneously creates new pools of liquidity while reaching into old ones. Price delivery is therefore engineered. It does not move randomly. It's delivered algorithmically towards areas of imbalance and liquidity. It is these characteristics that manifest in our charts as price action. We read into these moves not as reflections of value, but as the residue of intent. Like the strike marks left by a hammer on an anvil, each displacement, each fair value gap, and each stop hunt is the echo of an algorithmic decision, deliberate, repeatable, and observable. Most traders see price as consequence, but in truth, price is cause. We do not chase price, we interpret it. We do not trade reaction, we study delivery. Like metallurgists studying the textures of forged steel, we examine the shape of price to infer the force behind it. And in doing so, we align ourselves with the hand that swings the hammer, not the metal that absorbs the blow. Next, I want to conceptualize the strategy in this visual component. At this stage, I counsel you to think abstractly. In this abstraction of price action, I draw your attention to a number of key ICT concepts, the foundation of which is the breaker. The breaker is the price leg, which engages a measure of buy-side liquidity and a measure of sell-side liquidity. This will be the foundation of the strategy. nested in the dealing range, or a number, or should be a number, of important and distinguishable ICTPD arrays, the qualifier of which is the gauntlet fair value gap, which is the last fair value gap below sell side liquidity in the dealing range, or it is the fair value gap inside sell side liquidity. This fair value gap primarily will be used as a way to measure the opposing delivery of price. It is this measurement relative to the gauntlet fair value gap that allows us to actually enter the trade. It is the signal upon which the trade forms and the trade is validated. Above that, we will often see another price action phenomenon called an extended range candle fair value gap. These like to form at or below internal range levels. So either old lows or old highs. In this case, because it's a bullish breaker, it's an old low. The extended range candle will be often seem to form in price legs relative to old lows. These will become highly relevant in the opposing delivery of price. They are great candidates for inversion, and you'll see as we progress with our samples just how important identifying and extrapolating this imbalance is going to be. As you'll see later on, if you're not able initially to enter this location, the extended range candle inversion will offer an opportunity and a mechanism by which to enter the market. Another important consideration is the same process, the extended range candle fair value gap, but as it exists relative, in this case, to an old high rather than an old low, but the premise is very much the same. And the implications for price action are very important. And we'll go a little bit over that in the future. But we really have four main mechanisms for entry. The main one in this strategy is the gauntlet fair value gap. But I counsel you, if you're not yet familiar with some of these terms I have displayed on the slide, you really need to know what we're talking about here, because I don't think in this video anyway I'm going to really go through the implications of what all of these things mean for price action, but I will be referring to them. A lot of these things will become qualifiers and not necessarily in themselves mechanisms to enter trades. So this is essentially the pattern. It is a, in this case, we were looking at the bullish version, a bullish breaker. You would just have to invert all this in the case of a bearish scenario. But essentially, we have a dealing range that we internalize as a breaker. And in that dealing range needs to engage some measure of short-term buy-side liquidity with some measure of short-term sell-side liquidity. This is the first and foremost qualifying condition. It is the breaker. Yes, breakers are only qualified or conditioned as price moves above it, but this is a highly anticipatory. This is a highly anticipatory trade setup. But it doesn't mean it's difficult or that you need a lot of. You will need some measure of experience to pick up early on when this is forming. But I will, as we go on in the slide here, I will give you some context that will help you identify when these things are likely to form. retroactively, you do need experience and time with charts, with price action to really get the most out of it. But generally speaking, I will give you the context, easily identify these setups and these formations. So we'll move on. On this slide, I suggest pausing the video at this point, and I've got some concepts here which I will be referring to sort of retroactively and casually. But if you really don't know what they mean, you need to know what I'm referring to when I talk about some of the stuff. Because when we try to conceptualize what this pattern does or is doing, we'll be referring to the logic inferred by some of these concepts. Okay, so yeah, I'll probably provide this PDF. I'll have it saved somewhere. I don't know where I'll put that as yet. Maybe back on the Telegram. I haven't decided yet. Yeah, so moving on. There will be a few slides after this that I've labeled setup conditions. And this is the first one, and this one is talking about things in a... We're talking about the logic behind this trade, this logic behind the setup and the mechanisms within the setup. We'll be using the language of smart money, the implications of algorithmic intervention, and all those things that come with it, to lay the foundation for why a pattern like this actually works. What is the logic and why you can actually trust it. And if you understand what a pattern like this actually represents and tells you about the market, or what the market maker is trying to do with price, it gives you a great deal of confidence, of fortitude when trying to engage with this model, right? Because you feel empowered and on the right side. That's what I'm really trying to, hopefully I get through to the audience here and you guys here, why I've decided to do it this way. So we can read through this. Like I said, you can refer back to some of the definitions, because I'll be referring to them here in these explanations. So inside dealer range model, market maker sets a range in a session. The sweep of lows to trap retail before the real move. What I'm getting at here is that we'll often see this pattern form in a specific profile. That profile is the consolidation profile. I call it here a dealer range model because that's essentially what a consolidation is. It's a artificially constrained price range that the dealer has restricted price into, and will utilize the liquidity engineered as a way to move price later on. This sort of profile is often punctuated by the presence or the movement below the range. And with a number of these examples going forward, that this is a highly qualifying factor. If we can identify the range, if we can identify consolidation, we can begin to anticipate this profile in that consolidation. And that's what makes it very important and very powerful, in my opinion, because it also alludes you to the timing of when the consolidation is likely to be broken. If you are astute enough and you're just paying attention at the right time, you're going to see this form, and it's going to allude you to the high possibility that price is ready to take off in one sustained direction or trend. I won't say trend, I'll just say direction. You will see quick display. It'll often be punctuated by often be punctuated by a quick displacement as it moves out of the range. So that's why I say here is representative of liquidity engineered in a range to induce selling and facilitate an accumulation program for smart money to distribute later. So essentially that's it. What the dealer range does is it retroactively engineers liquidity, right? These price movements, as price is delivered lower and eventually outside of the range, that delivery is an opportunity for smart money to accumulate their positions. They won't accumulate essentially one candle, but they'll accumulate their position over a number of candles as price moves lower. So they get better and better price, and that's how they manage risk and how they hedge their positions. So eventually, this will often climax in some or other stop run, like we see over here, stop run outside of the range, right? So this price delivery this price delivery completes below short-term sell-side liquidity and in the form of a stop hunt outside of the range of the consolidation, right? Which is again representative of intermediate time frame liquidity. So types of liquidity engineered in the bullish breaker. The bullish breaker is fundamentally a pattern that reflects liquidity engineering. Price is moved to facilitate smart money accumulation and eventually take out stops at external range equality to fill large orders. It is engineered price delivery that builds in sell side liquidity by inducing and offering lower prices for retail to short. Again, because price is a tool, they can the market maker moves price, offering it lower and lower. They assume the other side of the trade. In doing so, assume risk, and it is in their interest to eventually reverse price and put their positions into profit. That's why we talk about the market maker's ability to facilitate order flow profitably. Okay, moving on. So that is the smart money logic behind this pattern. And the next thing we'll look at is the mechanisms of entry. Now there's more than one, because you can enter more than one position in this setup. But the best entry is, as price reclaims, the gauntlet fair value gap. So a gauntlet fair value gap is the lowest fair value gap within the price leg that breaks external liquidity, typically forming part of a bullish breaker structure. Just reiterating on some of the things I talked about before. So qualified by price delivery relative to its value area. So what I'm saying is here, in the opposing delivery of price over the value area of the gauntlet fair value gap, once, in my opinion, once the market delivers price through the value area outlined by that fair value gap, that's when I retroactively designated the gauntlet fair value gap. Now ICT, being more experienced, would say no, it's already a gauntlet fair value gap before the market had even done that, because he has a great level of anticipatory skill than someone like us. His prognostication ability is higher than mine or other people's. but I'm not astute enough, so I have to wait. I have to wait for that opposing delivery of price, and I have to see some other qualifying factors. I like to see some other qualifying factors, a number of conjoining confluences, essentially, that support that support support the idea that indeed this is what is actually forming in price. So that's why I say reflective of a true displacement leg, not just an imbalance. Also referring back to the gauntlet there, seen when algorithms reverse delivery through that value area, i.e. they retrace into it, but then close above the consequent encroachment, obviously, right, of that gauntlet fair value gap, validating the bullish intent, in my opinion. Okay, strong qualifying characteristics. At the lows, essentially inside sell side liquidity outside of the range of the accumulation, I want to see some SMT divergence. And because I'm primarily trading in this case the euro, I'm always using the dollar index as a way to keep track of SMT divergence. Okay. Another strong thing for me is immediate rebalance. Immediate rebalance is a beautiful characteristic of the algorithm that when I see that they've tipped their hand like this, I really get excited about the move. So immediate rebalance being when price quickly returns to an imbalance, like a fair value gap or volume imbalance, right after forming it, suggesting strong efficient market. No time wasted. This shows institutional intent and confirms a clear continuation or a reversal. And it's often followed by a energetic, really wide displacement. And our stop loss and take profit ideas for this mechanism of entry, well, it's really simple. Stop loss is below the previous swing low. So what I mean by previous swing low, I mean this low. Okay, I mean that low there. The stop loss has to be below that. And what's nice, what I like about this particular setup is if you are able to get in this early, is that you're not assuming a large degree of risk. Your risk is often quite small, less than 5 pips most of the time. Now your take profit ideas, your take profit strategies, I'll really leave that up to the individual. One thing I like to do is first take profit above the high of the breaker, and I'll look for some higher intermediate time frame imbalance above the market, and I'll look to that as the terminus for that particular position. Right, so the second mechanism for entry, so if you don't get in at the gauntlet fair value gap, if you don't get in at the gauntlet fair value gap, your second high probability entry is at the inverted extended range candle. Okay, I was talking about it before, but an extended range candle, I'll quickly go over what it is. In my mind, it is a fair value gap that has a rather large body. The body should be more, it should close towards the lower 90% of the entire range and the upper 10% of the entire candle's range. So it has a very large body with small wicks. The 10% figure is a little bit dynamic and depends on the instrument being traded. In the euro, I found the larger the better. The larger the body relative to the wicks, really the better. And I want to see that form. I want to see that candle close below an old low like that. That is a beautiful fair value gap. and these will offer really good inversions. The algorithm loves to keep back on this fair value gap, and we'll see with our examples. The number of times this happened is really crazy. And then actually, once you really pick up on this particular gap with this particular profile, it's really going to change the way you look at fair value gaps, in my opinion. So a technical description of the inverted extended range candle fair value gap reads as follows: relative to the opposing delivery of price through an extended range candle fair value gap, signatures of algorithmic intervention can support secondary entry. Entering our trades at the inverted extended range candle is often a more realistic option, as you don't always have the technical intuition to be able to catch the optimal trade entry at the gauntlet fair value gap. Also, an extended range candle tends to stand out due to the location and style of the body, and tends to provide a clear way in which to measure the opposing delivery of price and any mechanisms of intervention, i.e. observing candles that close above the consequent encroachment. An extended range candle that prints above an old high or low relative to the higher time frame consolidation often reflect algorithmic intervention and are powerful indications of imminent displacement or expansion. And that's what I say here. Extended range candles that forms above or below short-term highs or lows are powerful characteristics of algorithmic intervention and suggest imminent price expansion, often seen to form relative to some higher time frame consolidation. So let's go ahead and recap on some of the more salient and fundamental points that we've been talking about. So this is the conceptual framework. If you really internalize and accept that that price is really a tool of the market maker, and that the role of price delivery is to facilitate order flow profitably, then the logic of the setup lines you with the intent, meaning you gain clarity where others see noise. This strategy will mold your outlook, and instead of wondering about where price will go, you only analyze what liquidity has been taken and what liquidity has been engineered, and what the characteristics in price support the mechanisms of intent that will eventually deliver it to those areas. And most importantly, you begin to trade with patience and purpose, not to predict the future, but to follow the delivery of price back to its origin. So to recap, this setup tempers expectations by defining the profile in which it forms. It molds expectation by offering concrete stop loss and take profit objectives. It encourages and builds patience and encourages restraint. It removes FOMO by qualifying the conditional mechanisms for entry. So this is a collection of the most salient points that I believe this presentation has tried to expand on. So we'll move over to the setup process summary. I won't read through all of this, but essentially this here is an extensive checklist you can use as you try to navigate through the charts looking for this formation. The next few slides are going to provide examples of this formation. There will be bullish and bearish examples. I won't spend a lot of time on each one, but I'll point out the most salient proponents of each example, showing you where the breaker forms, how it engages liquidity, and where those salient PD arrays we talked about fit into the dealing range, and how you could have used them as a mechanism by which to enter into the trade. So this is our first example, and the one we've been primarily looking at as the template. This is a bullish example in the Euro USD. So you guys have been looking at this one for the last few slides. So there's not much more to say about this. Although it's a perfect example of the formation inside of a dealer range consolidation. Okay, you have buy side here, which is engaged at the top, making that this is the high of the breaker, and this will be the low of the breaker below the sell side liquidity. And as price is as the market maker reprices the market down into this low and eventually outside the consolidation, it engineers liquidity at the high over here. You have a reversal inside external range liquidity. You have your mechanism for entry, which is an immediate rebalance. This is a perfect example of the gauntlet fair value gap. And if you missed this entry, you could have deviated it and got in as price came back down into the inverted extended range candle. Okay, here we have a nice, again, extended range candle as it leaves the consolidation. And this is indication of intent. So I'll move over to another example in the euro. This pink shaded box indicates the high and low extremes of the consolidation that this price action was being held in. You have your buy side and sell side liquidity. You have the breaker, this being the dealing range. You have your extended range candle and your gauntlet fair value gap. Okay, you have a reversal in inside external range liquidity. You have a breakaway gap. This is a breakaway gap because the candles close outside of the range of the higher consolidation. There's no point in price coming back in here. This whole range is already balanced. And that's why that's a breakaway gap, because the whole range is already balanced, right? It's really interesting if you think about it that way. You can see the sensitivity to price as it comes back into that value area, and it continues way higher. So again, this is the same example by what we're looking at here. We're looking at a qualifier, a qualifying condition in price, and that's the presence of S&T divergence. So that's, again, that is a level confluence to see, and that really means that you're on the right side of the market and you're really interpreting the hand that strikes the anvil, so to speak. And again, another example, bullish example of an anvil setup in the Euro USD. Buy side liquidity, sell side liquidity. This is your extended range candle. This is your gauntlet fair value gap. This is your first entry. This is your second entry. And you have an extended range candle that forms and closes outside of the consolidation, meaning that that is a breakaway gap. Okay, that price doesn't need to come down in there because this whole range is balanced. That's why that is a breakaway gap. In the next example, we have a slightly clearer picture of the dealing range or the breaker, with sell side being engaged above this high, sell side being engaged above this low, below this low. We have two distinct examples of extended range candles, and both of these can be extrapolated out in time. Specifically, this lower one, it gives a deferred entry or a second entry opportunity. The gauntlet fair value gap, in this case, it designated at this location. The mechanism for entry is immediate rebalance on this candle there. Another example of immediate rebalance over there. So again, good examples of mechanisms for entries nested in PD arrays. And again, we'll move over. This is your extended range candle. This is a slightly elongated breaker, but the idea is still the same. This is your extended range candle, inverted fair value gap, and some of my old viewers might recognize this as a balanced price range. And this there is your gauntlet fair value gap, and you can extrapolate that, and you can just add that up. It's no need to really annotate this, but you can see how Our candles close and respect the value area of the gauntlet fair value gap after closing above it. So this is a bearish example in the euro. So this is our a dealing range and our bearish breaker. Sell side is engaged below this low, and buy side is engaged above this high. And here we have our gauntlet fair value gap, and that is your first entry. Here you have your extended range candle, inverted fair value gap. So this is a good example of why you might want to take profits be at the first external range liquidity location. Sometimes you get high retracements like this, although you're never in danger of being stopped down. In fact, price continues to be repriced lower. In this example, another example of a bearish anvil, setup in the euro. This one has the added confluence of a S&T divergence across in the dollar index and in the euro. And yes, it works in Bitcoin, right? So for my Bitcoin fans, there's your immediate rebalance inside your gauntlet fair value gap. Some more examples of bearish anvils. There's your anvil fair value gap. This is your dealing range. Again, this is your dealing range or breaker. Okay, inside that big price leg, that's your gauntlet fair value gap. You have had a benefit of S&T divergence. Now, this is the importance of having intermarket analysis on your charts. In the euro, yes, price penetrates the immediate rebalance. It shouldn't really do that, but in the dollar index, prices seem to respect those mechanisms for entry, and that's where you get that S&T. When you see a situation like this, it's something that you really need to take advantage of in your trading. So that'll end my array of examples, and I hope this lecture, this presentation, at least gets you thinking about the role of the market maker and the delivery of price. Gets you thinking how to think about a setup from a more holistic perspective, and contextual perspective specifically, and how it's important to sort of utilize a lot more of the skills and more of the concepts ICT teaches. His fundamental ideas need to be understood as a truth about the market in order for you to trade these concepts really well and effectively. And remember, guys, you have to practice this. You have to backtest this. You have to categorize and catalog your results. And when you see these formations, it's best to keep record of them, annotate them. This is how you develop your mind to focus in and actually identify these things as they form in real time. And thanks for watching. If you enjoyed the video, go ahead and give us a like and subscribe. And I think I'll be posting some more stuff, especially I want to do more market reviews, just in general, like sort of daily recaps and weekly recaps. I kind of like doing that. I do it anyway, so I might as well record it. Until next time, keep well and God bless.